Hey Leon, and within the blink of eye, we
We
are
are
back.
back.
And this is one of the serious topics we're going to talk about today, right?
How serious is serious?
Well, I think this is something we actually know a little bit about, right? At least in the insurance industry that we are in as well.
You mean in all the other topics we knew nothing about?
Well, there's a little bit of professional knowledge, a little bit more, right?
Yes,
And
yes.
also work knowledge as well. So some exposure that we have into this, everything else. Have you heard of anyone come to you? Obviously,
Yep.
in your experience as an investor and everything else, say,
Mhm.
Leon, you should take more. You should borrow more money. You should borrow more money and buy this stock, right? Because it's a definitely surefire. And if you're not going to do it,
Yeah.
you're going to lose big time.
Well, many a time.
Yes.
Right? Buy this stock, buy that stock. Right?
Buy stock.
Why? Insider information. Then you go, ooh.
And a lot of times when they say, sorry, I don't have money to buy the stock, then they come up with a very innovative way.
I would say innovative. It's been there for donkey years.
Correct. Right. Fair enough. Right. So I draw back the word innovative. Very established.
Established is a very established practice.
Yes.
It's,
and there's no it's established practice. Correct. Yes.
using a generic term, it's just called leveraging.
Yes.
Right. But obviously a more technical term, margin financing, loan financing, whatever we call it. In a way, even our home mortgage is on margin financing, right?
Right. So again, it's how you look at it. Right. So it's just at the end of the day, it's just a packaging.
Correct. It's just a packaging.
So that's the topic of the day today. Right. So it's about margin financing.
It's about margin
and the reason why we want to talk about it, I think it's very timely. I mean, we know the Feds are cutting interest rate. We had a massive 50 BP, even though a lot of people think you should not have gone that much and everything else. And there might be another 2 rates coming down in this year as well.
Yeah, November, December.
Yeah, so as interest rates goes down, certain things come up to the surface, right? And margin financing is things that has been around, right? And obviously it works well when interest rates are low, not when it's very high.
Correct.
Right? So maybe for most of the audience, maybe you can explain in a very succinct way what margin financing is.
Well, margin financing essentially, in very layman terms, is borrowing money to invest.
Right.
Full stop. And you hope to borrow at competitive rates, and you hope to invest in instruments that bring you obviously more than the interest rates.
Yes. Okay. So this is very specific to borrowing money to buy stocks, right? But obviously you can apply in different fields and different areas.
Correct. Right. I mean, you can even apply to properties, right? A lot of people buy their second properties again, paying 20% or whatever. The rest is all loans.
Yes. And obviously when you buy properties, they tell you that it's one of those things that over time your collateral increases. Your value increases, but your finance at your original value. Right.
Correct.
Okay. So that's one of the upsides of property. At least that's what we. So by the end of the day, don't mistake it. Not you are taking leverage.
Correct.
Right. You are taking leverage, and that's why there's big concern about people overtaking the leverage. And then right now, if you're buying a property, you have to abide by LTV ratio. I almost wanted to say LTVP. So we means that means totally a different thing. So LTV ratio, right? Precisely to make sure that you do not take more risk on financing more than what you're used to.
Yeah, right? That's the way the authorities are trying to protect people against their wishes to be more leveraged.
Yes. So margin financing itself, as Leon was talking about it, everything, it is a tool, right? It's a way for you to get access to certain products and services, right? But obviously there is risk associated with that.
So, in a nutshell, when things are going well, which means, say for example, if the things you are investing into are rising, it can work.
Right.
If
the word is if, right?
If, right? Yeah. It is a big if. Right? So, for example, if you're borrowing at interest cost 2%,
yes,
and if you're pumping into an investment solution that's bringing you 7-8%, you make a net margin of 5-6%.
Right.
Thin air.
Yeah.
Right.
Yeah. So listen to that, right? So there's a probability that you will lose. Right. There's a probability because the probability is staked on the fact that the bet that you're making on, right, goes the other way. Right. And we know the stock market, no one can make a call for the next day, right? There's a probability that it can go down, go up. So even the person who's actually making the leverage, right, he needs to have a certain risk level.
Yeah, of course.
Right.
Well, again, that's dependent on the solutions you are getting into as well. For example, if you're borrowing at 2% and you're trying to invest in something that supposedly can bring you 15-20%,
Yes.
that sounds like a very high risk strategy.
Correct.
Right.
Correct.
Because if it sounds like it's going to be very speculative.
Yes.
And there are solutions where you borrow at 2%. They are trying to park into something that probably brings you like 3.5-4%. That is probably of moderate risk.
Correct.
Yeah.
Correct. I mean, the concern comes into play when a person who's doing well, with a very high risk profile, aggressive profile, he's gone through his fair shares of up and down, and is very comfortable with leverage, interacting with a group of people whose risk level are very mixed. Right? So imagine the guy who's a conservative person, who's probably still having his fixed deposit, right? Getting enchanted by this quick money, right? Because I'm creating something out of nothing, right? I'm borrowing 2% based on whatever you have and everything else, putting it into something else. And nowadays, for example, if you talk about stock investing, the brokerage offers this facility.
All of them.
Yes.
All of them. Just to talk to the greed nature in all of us. One thing to note is, as we're saying, if things are going well, we can actually make money.
Yes.
If things are not going well, you can actually lose more than what you put in.
Yes.
Because of the nature of the leveraging, you know. For example, if you go to buy a stock, 1,000 shares, using your own money, $3, the max you will lose is $3,000.
Correct.
Right. But if you're using margin financing or one of those facilities, you can end up buying 10,000 shares because you're borrowing money.
Right.
And if you lose, you're going to lose $30,000.
Correct.
Right.
Correct. The caveat here is that not everyone can get margin financing, right? You got to have a certain kind of collateral in your account, certain amount of volume of shares you need to own. So the margin or the loan they're providing you is against this collateral that you have, and they give it to you at a very low interest rate, so that you're able to borrow from them and put it into the market.
Yeah. So the nature of the beast is such that if the value of the collateral goes up, and your investments go up, you can actually borrow even more. Consequently, if the value goes down, you end up with this thing called a margin call. Right? Your broker will be calling up, "Hey, Suresh, how have you been? Hey, by the way, I just look at your numbers and you're triggering a margin call. Can you top up $5,000 between now and tomorrow afternoon?" Right? Otherwise, we will force sell.
Yeah, and you don't want to be end of a margin call. You don't want to be end of a margin call.
It can be very distressing.
It can be very, very painful, distressing. You might, I mean, not just losing sleep, it can be a very traumatic event to you as well.
It can be.
Given the fact that if it's really big sums of money, right?
It can have dire financial consequences.
Yeah. But having talking about this, but do you think a lot of people in generally in Singapore, let's not go away, use margin financing to enrich themselves?
I mean, I don't have the numbers, but some of them do it for a more grounded reason. Like for example, just now we talk about stocks. It sounds like we're talking about stocks, but you can also do it for example, some insurance policies,
right?
Your whole life plans where the returns are not exceptionally high and they tend to be more predictable. You know, usually comes with a guaranteed portion and a bonus component.
Right. So how? So let's good. So moving to the insurance. So how does someone use margin financing to buy in this case, buy a whole life policy?
Yeah, so you typically can go through a financial advisor or a rep of a financial advisor or a bank, right? You say, okay, I want to buy this policy for X dollars, but I want 60-70% to be financed through a loan. So essentially, it's almost like buying a property, right? You don't pay everything up front.
Yeah, and the loan is given by the provider, the insurance provider themselves, right?
Yeah, correct.
Okay,
correct.
Okay.
So in a way, it allows you to buy a bigger policy than you otherwise could afford.
Right.
The bank makes money, of course, because they loan you the money.
Right. Okay.
The insurance company makes money, of course, because they
get the premiums from you.
Yeah, correct. Right. So it's a win-win-win. It could be a win-win-win situation.
But so at the end of the day, when you come out of that, you're actually paying both the premiums and the interest for the loan.
Correct. But it's usually structured in such a way that the payout from the insurance policy should offset the interest.
Right. So when you say payout, so if you're talking about whole life policy,
correct.
We know it pays out when you.
No. It can pay out after 3 years, 4 years.
Right.
So it's structured in such a way that first 3 years you're probably out of what we call out of pocket. You've
Yes.
got to pay the interest rates because
Right.
there's nothing being paid out of the
And
insurance
then after
policy.
3 years
After 3
later,
years, the insurance policy should pay
and cover.
and cover and more than cover. So
Right.
you end up sort of like getting passive income.
Right. Sure.
Yeah.
So let's say, so it seems to me that in this product itself,
Yeah.
right? Firstly, you don't have that structure for all the insurance products.
Correct.
Selected
Correct.
insurance product,
Selected
number one, right?
insurance product. Yeah.
And number two, like there is a certain period of time, initial period of the years,
Yeah.
you got to be cash out of the pocket.
Correct.
Right.
Yeah.
And this is more, even though the way it's structured,
Yeah.
it still is a product that you might still more prefer more when interest rates are low than
Yes.
high.
Correct.
Because if it's high, then you're going to be paying cash pay out of pocket longer.
And probably, yeah, exactly. So the good thing about doing it for insurance policy is, unlike, just now we talk about stock prices,
Right.
it can go up 15%, 20% a day,
Sure,
but it
sure.
can also go move in the other direction.
Sure.
With insurance policies, you're unlikely to see that kind of price movement.
Right.
So you're unlikely to have a margin call.
So there's no margin call. There's no such
margin.
thing.
It's like, oh, sorry, your policy from.
So the only downside to anyone is being able to have the money to ensure the first few years of cash
Yeah.
out of your pocket,
Yeah.
you're able to pay it up, right?
Yeah.
That's the only downside, right? You can't miss that.
There is another downside.
Yeah.
Is a couple more. The other downside is you cannot surrender the policy early. As with a normal insurance policy, if you surrender early, you end up losing some value
on the policy.
Correct.
But the loan,
Yeah.
would you have any impact on the loan?
No, but
Okay.
you've got to repay the loan as well.
Right, because the loan is X amount of dollars, right?
Correct.
And it's based on the fact that the policy is not surrendered for X period of
Correct.
time.
Exactly.
Right? Okay.
So with a lot of policies, first few years you probably lose 20% you surrender.
Right.
Right.
Okay.
So if you think about it, you would take on a 500k policy. 20% is 100k.
Okay.
Yep.
I did. Okay. 20% 100k.
Okay.
Yes.
As with a normal insurance policy that's financed through your own resources, you've got to stay for the long term.
Yes.
Mm.
Yes.
Mm.
Yes. Yes.
Yeah.
So again, okay. So these are so are these more towards whole life policies, premium financing?
Yes, usually they are.
Okay.
I've never seen a policy that lasts 15, 20 years that are available for premium financing.
Right.
Yeah.
Sure. So there are risks to taking premium financing as well. So imagine, so what happened when people taking the premium financing, the old interest rate regimen, when you had very low interest rate,
correct.
and the interest rate started popping up, right?
Yeah, like what we've seen. Yeah.
So started popping up. So what happened? So everyone at I wouldn't say margin call, but they probably had re-rating of the interest rates.
Well, so for example, if somebody would take on such an arrangement in 2021 when interest rates were really low,
yes,
they were looking at maybe 2.4, 2.5%.
Right.
And then obviously it's now gone up to 4.5%. Right?
Yep.
Yeah. So they have to pay more out of pocket in the first 3-4 years when the insurance contract is not paying anything.
Yeah, so that's assuming it's all a flexible rate. I'm assuming.
Yeah, it is.
So it's always a flexible rate.
Yeah.
So the insurance, so the banks do not
lock in for like 2 years.
So they don't take absolute risk. They push the risk out of the market.
Obviously, the risk is
of course. So remember, right? There's no such thing as a free lunch.
Yeah.
Right. So okay, that's really so we talked about margin financing as a concept. We talked about it in stock financing. We talked about it in the insurance world as well. And there are other ways we can a third way that we've actually understand how you can use margin financing, right? Pretty much buying overseas.
Oh yeah. So I saw as I forwarded you recently, I saw something from popular funds platform.
Yes.
Sean, review the name to protect the innocent. Touting, borrowing cheap money to invest overseas. For example, was it in August we had this issue around what they call the Japanese yen carryover trade.
Yes.
Basically, investors were borrowing yen at very low interest rate and investing somewhere else. Right, to get the US market. US market.
Yeah. So that's why when the yen interest rate, there was a big move.
There was a big move. Yeah, correct.
And there was a big
correct. And that helped fuel the tech bubble as well. So I mean, this popular funds platform was also touting this solution for what we call accredited investors. Basically, borrowing yen and buying overseas funds.
Yeah, overseas funds.
And then you get a spread. Because a yen borrowing cost for non-preferred clients are about 2%.
2%,
Yeah,
right?
yeah.
And you invest in something.
If something that bring you like 6, 7, 8%.
So let's say you
Yeah.
invest in something where the dividends itself is
Yeah,
5%. You have a
correct.
consistent dividends.
Correct.
Capital goes up and down.
Yep.
It don't matter,
Yep.
right? Because you have 5% dividends coming up.
Yep.
You settle the 2%.
Yep.
You make a 3%.
You make
net.
a 3%.
At least that is a pitch.
So the advantage with this solution is that unlike with the insurance policy one, you don't have to wait. Because when you buy into the fund, the dividend probably comes in next month.
Right.
There's no 3-year waiting period or accumulation period, as we say.
Right. Okay. Yeah, fair enough. So
and the other advantage is there is no loss in early surrender.
Yeah. Okay. You can sell anytime.
You can sell anytime.
So
I can sell next month.
You can sell anytime and everything else.
Yeah,
Right?
correct.
Yeah. Sometimes I wonder, right? Sometimes I wonder if it's such a good way of doing it. And all these platforms which is actually they have a lot of float. They call got a lot of float as a market maker. You need to have that amount of float and everything else, right? You could do the same. The market makers could do exactly what they're promoting the retail market.
They can,
and they can get the 5%, right?
Yeah, they can.
Maybe they are doing it. But obviously, we also know. They're also not allowed to take so much of risk, right?
Yeah.
So of course, diversifying the risk, getting money from elsewhere, getting other people chance to get in.
This one is for accredited investors who are deemed to be more knowledgeable.
Yeah. I mean, in the investment world, sophistication, right? So somehow sophistication is very closely related to your net worth and how much value that you have.
Correct. So else, right? If you have this amount of net worth, you're assumed to be more sophisticated. You're assumed to understand the risk.
I've known fishmongers with a very high net worth value. Yeah. Okay. So anyway, not every concept is free. There's always some flaws in certain concepts and everything else. But anyway, we discussed about 2-3 things where we see margin financing and we do see some of this acting up again, right? As we see the interest rates coming down, right? As we see and as we talk and we discuss, there's no such thing as free lunch. There's always a risk. So understand your risk, but most importantly, right? Understand your risk profile.
Yes, correct. Right. Understand your financial planning objectives. Make sure you're not losing your pants, right?
Yes.
Importantly, because with some of these instruments, you can actually, end up in severe financial consequences.
Yes.
Very dire ones. Yeah.
Very dire ones. So so there's no such thing. I mean, everyone likes to tout the fact of quick wins, right? Of quick victories or what do you call you got to strike the deal right now, right? I think in all circumstances you can wait. I think it's worth the wait, worth to think through things like this margin financing, especially when it's a sophisticated concept, sophisticated deal, and the fact they don't open it to everyone tells you something.
Tells you something. It does tell you something.
Yeah. So I think on that note, and until to the next call, have a good one and stay safe.
Cheers.